Hey guys, Tony here. Welcome back to my next video on the wheel strategy, a strategy that I use every week here on the channel to generate income for my portfolio. In my very first video, I went over with you a high-level overview of the wheel strategy and why I like it so much. I will put a link to that video up in the top right-hand corner of your screen right now, as well as a link to it in the video description. Be sure and check that one out if you have not watched it yet. In this video, we're going to go through selling cash secured puts, step one of the wheel strategy. We'll talk about how to select a stock, what are the benefits of cash secured puts, what are some of the risks that you need to be aware of, and we'll close up with an example of selling a cash secured put. If this sounds like some information that you are looking for, let's get right into it. As we talked about in the previous video, the wheel strategy is a system to generate income from options premium through selling cash secured puts, potentially owning the underlying stock, and then selling covered calls on it once you own it. The system should be utilized on a stock you would like to own and at a strike price that you are comfortable with owning that stock at. I always like to make sure that we talk about the overall risk of the wheel strategy. This is a options trading strategy, and options trading has inherent risks. Using the wheel strategy requires that you understand basic options trading and proper risk management. Don't feel that you need to rush into using this right away. Make sure that you do your homework and understand options trading before utilizing the wheel strategy. And I do have a video for how to do simulated paper trades on options. I'll put a link to that up above in the top right-hand corner here and in the video description as well. For those of you that are very new beginners to options trading, let's talk about what is a cash secured put and when would we use it. A cash secured put is ideal for investors who are looking for a short-term price dip on a stock followed by longer-term price appreciation. And maybe they want to buy that stock if only the price would go down a little bit. And instead of waiting, we can actually generate income selling puts and then get an entry into that stock if the price does give us the expected dip. Cash secured puts involve selling, or what we call writing a put, and simultaneously setting aside the amount of cash necessary to buy the stock if it is assigned. So you want to make sure you have enough cash in your account to buy 100 shares of the stock or however many puts that you wish to sell in increments of 100 shares of the stock. Make sure you have that cash in your account before you begin this strategy. If things go as hoped, the cash secured put allows an investor to buy the stock at a price below its current market value if you get that dip. When we are using cash secured puts, we're typically choosing an out of the money put option. An out of the money put means that we are choosing a strike price for our put option that is below the current market price of the stock that we want to buy. I know a lot of people have negative connotations about put options. You think that people that trade in put options are betting on the price of a stock to go down. However, when we're talking about cash secured puts, the motivation of the investor is to sell a cash secured puts as a acquisition strategy to buy the stock. And generally that investor is price sensitive and they are not willing to buy the stock at the current price, but they would buy it if the price fell a little bit more. And as I said a minute ago, rather than just waiting and keeping your money on the side, you could sell a put and generate income while you're waiting for that price to come down. A cash secured put writer actually wants to acquire the underlying stock via what we call assignment. The strike price of the put minus the premium received represents a desirable purchase price. And don't worry, we'll go through an example for that to make sense to you in just a minute. Keep in mind that put assignment is not guaranteed. If the stock doesn't drop, if it remains above your strike price during the life of your option, whether that's a week, a month, or a 1-year option, generally we're doing 1 week or 1 month puts. If the price remains above the strike price, you will miss out on the stock purchase, but then you just repeat selling the put, and you hope that the price comes down in the next cycle. The consolation of missing out on buying the stock, though, is that you collect income from selling that put. And no matter what happens, you get to keep that income every week or every month, depending on the length of the put option that you're selling. Now let's talk about some of the benefits and risks of selling cash secured puts for the wheel strategy. The first and most obvious benefit is generating income for yourself every week or every month. The person that is selling the put option collects premium on the day that you sell that put option, and that premium is yours to keep no matter what. The second benefit is cost reduction on the stock that you're wanting to buy. Selling the put options allow you to potentially purchase the underlying stock at a discount to the current market price. In a typical scenario that we look at, the stock price dips to the strike price that you chose. You get assigned the stock, which means you buy it. And the premium that you received from selling that put option reduces your cost basis. It reduces the per share cost of the stock that you bought. Again, we'll go through an example of that at the end of this video. And the last major benefit from selling cash secured puts, or selling any options really, is that theta, or time decay, works on the side of options sellers. Since options decline in value as they approach the expiration date, writing or selling options generally makes theta work in the seller's favor. And I want you to think of that time decay as favoring option sellers who profit unless a specific event occurs to drop the underlying stock price. What are some of the risks of selling cash secured puts? Assignment risk is one, but that is what we consider a slight risk. Since the goal of the wheel strategy is to acquire the stock, we don't generally consider assignment risk a problem. How do you mitigate assignment risk? You want to make sure that you choose a strike price on your puts carefully and make sure that that strike price is at a price where you are happy to own the stock at. We'll go over that more in the example at the end of this video. The second risk is what we call volatility risk. If you choose a high volatility stock and the stock price drops quickly, you may end up owning the stock at a much higher price than the current market price. And the way to mitigate that risk, if that is something that you're worried about, is don't pick high volatility stocks for the wheel strategy. Choose one with low volatility. The third risk that comes to mind is the maximum loss risk. If the underlying stock that you choose were to plummet in price due to some bad news that the company has, and let's say in the worst case scenario, just to make this make sense, the company were to announce that they were going to file Chapter 11 and the price plummets close to zero, and you had a $10 strike price that you had picked a week or 30 days prior, you're still obligated to buy that stock at the strike price that you chose. Until that put option expires, you must be comfortable with the strike price you chose as an acceptable long-term acquisition price, no matter how low the underlying stock price or the stock market goes. Yes, if the stock market crashes, the stock you chose may also go down in value, even though the company itself doesn't have any specific company news relative to that company. How do you mitigate this maximum loss risk? You would mitigate it by choosing only companies with strong fundamentals and strong financials. If you are utilizing the wheel strategy on a company with weak fundamentals or weak financials, let's say, for an example, a company that has negative net income or a cash flow problem, well, that is a high volatility stock typically. And you would want to avoid those if your goal is to minimize maximum loss risk. To minimize maximum loss risk, pick companies with strong fundamentals, a long history of generating income, long history of positive operating cash flows. Keep in mind, this is the stock market we're talking about, and we can't control every risk. All investments have some risk, but these are some of the common risks that we look at with this strategy and potential ways that you can mitigate them if those risks are something that you are worried about for your portfolio. Just a couple of other random thoughts before we get into how to choose your stock and walk through an example for you. When you're utilizing the wheel and you're selling cash secured puts, you are tying up some of your capital or some of your cash. You need to have that cash in your brokerage account before you sell the cash secured put. And although it will remain in your account, you won't be able to use it for other purposes. It's going to be collateral for your cash secured put. And that just might be something you want to think about. Is there a better use for that cash? Could you invest it in something else to generate more income than the income you're generating from selling that cash secured put? For this reason, try to identify a stock which you were planning to purchase anyways, if only the price would drop just a little bit more. Those are good candidates for the wheel strategy. You had the cash, you were thinking about buying it. Well, just go ahead and sell a cash secured put. You were going to use that cash to buy that stock eventually anyways. The other thing we think about is market conditions. The wheel strategy works best in a neutral or slowly trending market. This is because of volatility. In highly volatile markets, the risks of this strategy can be higher. As you build up more and more experience using the wheel strategy, you'll learn how to compensate for higher volatility in the markets. And then the final thing, we already talked about this just a minute ago, is stock volatility. The company that you're picking, selling cash secured puts on highly volatile stocks does increase your risk. Many of us choose purposely to trade the wheel on highly volatile stocks. But if you are a beginner to the wheel strategy or selling cash secured puts, you might want to start out avoiding highly volatile stocks because there is more risk and more things that you're going to need to pay attention to. As we get close to wrapping up here and going through that example, let's talk about some of the most common questions that people have with the wheel. And starting off, those questions have to do with choice. First of all, you have to choose a stock. How do I choose a stock, Tony? I want you to think about selecting a stock that you are comfortable with potentially owning long term, because if you get assigned on that stock, you are going to own the stock. For minimal risk, choose a stock with low volatility. You can choose a stock with higher volatility, and those are sometimes favored by more experienced wheel traders because we generate more income, higher option premiums. But there is more risk that comes with those higher premiums. If you want to minimize your risks starting out, choose a stock with low volatility. Companies with strong fundamentals are ideal for this lower risk, lower volatility for beginners. The final thing when you're selecting your stock to do is go over to the options table for the stock and look for one with high options liquidity. What do I mean by that? I want you to find one where there's high volume in trading, high open interest on those options, and make sure that the bid-ask spread is very tight. You'll notice that on options that don't have high liquidity, meaning there's not high volume or not high open interest, that the bid and ask might be very far apart on an option that you're thinking about buying. Try to remember to look at the options table before you select your stock and make sure that the options that you're looking at have tight bid-ask spreads. Once we select our company, we've chosen our stock, the next thing we need to do is choose a strike price for our cash secured put. And typically wheel strategy traders choose a strike price that is below the current stock price. At some fundamental or chart technical level, they are comfortable owning the stock at were they to be assigned. The decision of that strike price ultimately comes down to your own individual risk tolerance. What price are you comfortable buying that stock at, no matter what happens? The third decision you'll have to make is choosing an expiration date for your cash secured put. I typically do weekly options, although there are some stocks with lower volatility that I might do monthlies on. And there's no right or wrong answer. As I say here in this third bullet point, the decision may vary depending on the stock's volatility or the market volatility. Also, I want you to be aware of, as you're choosing your expiration date, be aware of earnings dates that might be coming up for that stock, because volatility may increase and the stock may swing wildly up or down around an earnings date. That is something very important I want you to keep in mind. Always be aware of the upcoming earnings dates and see if the earnings date is falling around an expiration date that you're looking at for your option, and then maybe pick a different date. The fourth choice is kind of a bonus. You could choose to do the wheel on dividend stocks. If the company you choose is paying a dividend, you could potentially receive an additional income stream if you were assigned and holding that stock, getting regular dividends from the company. That generates for you passive income plus a reduction in your overall portfolio volatility. Okay, let's wrap this up with an example. And guys, don't forget, if you have questions about this video or the wheel in general, don't forget to leave me a comment down below. There are more videos coming out on the wheel, and any comments or questions that you guys have to help drive the future content on the wheel, I'm happy to entertain those. I love to hear from you down in the comments. Moving into the example, we're going to look at an investor who wants to buy CVS, 100 shares of CVS, but not at today's current price. It's just a little bit too high for our theoretical investor here. CVS is currently trading at $60 with an analyst's 12-month average target of $76, which would be a nice 12-month return, and a 12-month average low target from the analyst of $58. But our investor says, I don't want to pay 60 and I don't want to pay 58, but I'd be happy paying 55 for CVS. So in the middle of the slide here, we have a summary. The current price of CVS is $60. The investor is willing to buy it at 55. So they're going to sell an out of the money cash secured put with a $55 strike, expiring in 30 days. And when we go look at the options table for options that are 30 days away, the premium that the investor would collect would be 40 cents. That's the price in the options table. Since a options premium is on 100 shares, we multiply that premium times 100, and the premium that you would collect selling that option would be $40. And since you are willing to buy 100 shares, in 30 days, if the price drops to $55 or below, you must have $5,500 in your account in cash. That's $55 times 100 shares, $5,500. Now, for some of you that are starting out, that might be too high. And this is just an example. You can choose your own stock with a lower price than $55. There are stocks that I do the wheel on that have a $5 price where I'm collecting 25, 30, 40 bucks a week, but they are higher risk, higher volatility, higher risk, higher premium collected. Let's stick in this example though with CVS. It is a higher price, but it is lower volatility and lower risk. So we're going to sell the $55 strike. We're going to collect 40 bucks, and then we're going to wait 30 days and see what happens. If in 30 days, CVS is still above 55 bucks. Let's just say it traded flat at 60, 61, 62. The put option that we sold is going to expire, and the income we generated over that 30-day period was $40. We got that on day one. We get to keep all of that 40 bucks no matter what. And then because CVS did not fall down to our $55 level that we wanted to buy it at, we're going to repeat the wheel. We're going to sell another cash secured put and start the process over again. Maybe we choose the $55 strike again, or maybe we make an adjustment depending on what the current price of CVS is in 30 days when we're doing the next phase of our wheel. If, however, the price of CVS dropped as we were hoping it would, and it came down below 55 bucks, then we are going to be assigned. We're going to be assigned those shares, and we will need to buy 100 shares of CVS at $55, and the broker is going to take our $5,500 cash. That's going to be removed from your account, and on Monday, you're going to see 100 shares of CVS now in your portfolio. If you had just bought those shares in the market at 55 bucks by waiting for the price to drop, your cost basis would be $55 per share. However, remember, we sold cash secured puts. So we're going to subtract the income we made from our cost basis. $5,500 minus $40, or $55 minus 40 cents, same math, gives us a cost basis of $54.60 per share for our CVS. Now, if we had been doing this for weeks and weeks or months and months, collecting that premium over and over, our cost basis for CVS, by the time we finally get those shares assigned to us, could be well below $54.60. If I had been doing this process, collecting $40 a month for 3 months in a row before I got assigned, that's $40 times 3 months, $120 or $1.20 per share, meaning that my cost basis would now be $53.80 on my CVS shares. There have been cases on low price stocks, say like in the $5 range, that are very high volatility, high risk, where the options premium is very, very high, where by the time I get assigned, the stock drops to $4.50. My cost basis might be $3.75, $3.50. And that is a meaningful reduction in the cost basis of these high volatility stocks. It might not look as impressive on a low volatility stock like CVS, where you're only trading it on a monthly basis. But this is just one example, and I need to show you a reasonable low risk example to properly explain the wheel to a beginner. Either you did not get assigned the shares, in which case you just repeat the process by selling cash secured puts again on Monday, or you're going to get assigned the shares, in which case you pivot to step 2 of the wheel strategy. And that is, starting on Monday, you're going to now sell covered calls on your shares. And I'm going to cover that for you guys in the very next video, the wheel step 2. Selling covered calls. So be sure and look for that video. Subscribe and turn on notifications if you are new to the channel. That video will be coming out in the next few days or over the next week. Once we get assigned the shares, we're going to sell covered calls to again generate weekly or monthly income while we wait for CVS to then go to our price target. Remember that analysts had given CVS a 12-month price target of $76. Now that I'm in CVS at $54.60, I'd like to sell it sometime in the next year at $76 if it runs up to that price. And however long that takes, I'd like to be generating income along the way by selling covered calls. As a bonus, CVS pays dividends. So while we're selling covered calls, while we're waiting for CVS price to improve to $76, we're going to be able to collect quarterly dividends as an additional income stream along the way. This is the thumbnail of the upcoming video, the one that we're going to go over next for selling those covered calls. Keep an eye out for that video. Again, drop me any comments or questions you have down below. I am Tony Denaro. Thank you for your time, and I will see ya on the next video.